Rotten week for the stock market. 4 straight weeks of losses, to be exact. More than 1,300 points down on the Dow in just the first 3 weeks of August. And this probably won't catch you by surprise. The S&P, the NASDAQ, the Dow, all down. Ron Hart is with me now. He's the managing director at Morgan Stanley Smith Barney. So I asked you this before the break. So should we fasten our seatbelts? Are we in for another rocky week?
It's very volatile right now. Right now, this week has been one of the most volatile weeks in a long time. There's unknown contagion in Europe. No one knows exactly what's going to happen overseas and in America. So there's fear. But within fear, there's also always opportunity.
And what is the key factor in terms of what's driving that fear?
Well, the growth rate of global GDP has been lower. We went from 4.2 to 3.9 global GDP. So the market's really repricing risk and the market's for slower growth.
Are there any key economic indicators that we're looking for next week that are coming out?
You'd like to see the housing numbers better. I mean, that would help a good bit. The housing sector's really hurt our economy in the United States more so than Europe. Seeing that back would be good. We'd like to see employment numbers get better. We go for 200,000 jobs a month down to 125,000 jobs a month in our estimate.
That's, well,
a little bit too.
Right. Morgan Stanley says about the U.S. markets, it ain't great, but it ain't 2008. Is that true? Are we not in for another double-dip recession? Or what's your view on this?
I think we get close to a recession, but we don't think we're going to have one. 2008 was a little bit different. There was a lot more leverage on the balance sheets. Right now, there's 1.5 trillion in corporations and cash coffers. They can weather a storm better than they ever could before. Also, the balance sheets of banks are a lot better. Some that were 20, 30 to 1 leverage are now 10 to 1 leverage. So we're better prepared for a downturn.
So those bank bailouts worked,
well,
you think?
they did to some degree, probably by infusing liquidity into the system, but also they had to pare back their risk, right? If you're 20 to 1 leverage, you've got to do some things to get back to 10 to 1. So they had to pare back their own balance sheets as well.
Well, it's interesting because I saw this piece in the New York Times last week or the week before, I believe, that talked about the luxury retail market being quite strong.
Right.
And it seems like there's this real disconnect, or is there just between the haves and the have-nots?
Well, there's a bifurcation in some ways, but for years, Walmart and Dollar Tree did well at the low end. So there's different times in which things do well. The high end can be a lot of European buying in the United States. You go to New York, I don't know how much time you spend in New York.
Well, people are bringing suitcases to do their buying.
And the dollar's weak, so there's some value there. And as a result, there's some spending. The amazing thing about economies, as you well know, that there's a way of balancing out over time. If your dollar's weak, people come in and take advantage of it, strengthens it. So it's very self-correcting at times.
You know, for people, all of my friends, when I speak to them, they say, I'm not even going to look at my 401k. You know, is that the right approach? I spoke to somebody yesterday who said, you might want to just sort of stay put, don't make any big changes. But what's your advice on this?
Well, historically, when the market's down 8%, the next year it's up over 20%. So people tend to react to what just happened. If you're nervous about your positions, you know, sell back to a position where you can sleep at night and listen to an advisor. You know, sit down and see what your asset allocation is, what your age is, what your expectations are, and then reallocate based off of that.
So you're not, even though you think you may be a smart mind, find a smarter mind to help you.
Indeed, especially in this area.
All right, Ron Hart with Morgan Stanley Smith Barney. Thank you so much for your insight.
Thanks, Elaine.